The Liberal Democrats could play the role of kingmakers in the event of a hung parliament, and that outcome's got, well, investors worried. They're concerned a minority government wouldn't be strong enough to cut spending and bring the deficit under control. PIMCO, for one thing, saying that the pound will drop without rapid action and recommends bunts over gilts, i.e. German debt over British ones. Not everyone agrees, though. Ignis Asset Management is buying UK debt and says that the pound will retain its value. So who's right and who's wrong? Well, let's put that question to our next guest. He's Stuart Thomson. He's from Ignis Asset Management. Stuart, great to see you. Well, who is right here in your view?
Well, we think the outcome is binary for the election. If there's a hung parliament and if Gordon Brown tries to cling on to power, then sterling will weaken due to the increased uncertainty. If the Conservatives win, then an outright majority, then we will see sterling rise rapidly as underweight investors are forced to come in.
Why would that be the case? I mean, is that the view, essentially, that the Tories have the right policies, or is it just to get rid of what the city sees as a discredited government?
Well, it's a reduction in uncertainty if there is an outright majority for the Conservatives. The Conservatives are basically ahead of the rating agencies, whereas Labour are behind the rating agencies. So they will let the rating agencies seize the initiative, and the financial markets won't respect that.
Right, so what are you doing and how are you placing your portfolio ahead of this?
Well, we're focusing on competition for capital. We're seeing very steep yield curves. We're starting to see governments raise real interest rates. And since the government is the £800 gorilla in the room, that is starting to take funds away from riskier assets and into the gilt market. So we have been reducing our exposure to credit, taking a profit on expensive credit and putting it into the gilt market.
Many people have compared the situation at the moment with the budget deficit with that of Greece's, but we do have, well, at least a currency that floats, which perhaps gives Britain an advantage here. But are these comparisons unfair?
Those comparisons are very unfair. We do have sovereignty over our currency, and sovereignty counts when it comes to competition for capital, as Greece has demonstrated over the last few months.
Now, what about Greek debt? Have you been in the market for that?
We have avoided Greek debt. We will continue to avoid Greek debt. We believe that over the next 1 to 2 years, we will have to see a partial default of Greek government debt, a restructuring to reduce the cost to Greece and to the debtors within Greece.
But explain what you mean by partial default here and how it would be restructured.
Well, what we mean there is a haircut of 20 to 25% on the creditors. Otherwise, you're creating debt deflation for the debtors within Greece. We believe that will be politically unacceptable over the next couple of years.
Stuart, very quickly, overall, though, going back to the UK, are you, at the moment, decreasing your holdings which are sterling denominated?
No, we're not.
So you're fairly confident that we're going to get something clear-cut here?
We're fairly confident there will be a resolution after the election. One of the things we think is that any knee-jerk response to the election outcome, you should reverse within a few days. For example, a Conservative election victory would be very good for sterling, but that creates tight fiscal, loose monetary policy, which would see sterling weaken and vice versa.
Stuart, thank you so much for joining us. Stuart Thomson there from Ignis Asset Management.